Awesome. So we're having conversations. What sounds like, Jim, is you have access to some high net worth small business owners, and you're trying to introduce the concept of golden handcuff structured policies and key man insurances, correct?
Yeah, I want to understand, key man insurance, doing executive bonus, policies,
Okay.
and then understand a little bit about, Kaizen and premium financing in as well.
Gotcha. Let me write this down so I can make sure we talk about both of these. So key man, golden handcuffs, and premium financing. Okay, gotcha. So what exactly is key man insurance? Key man insurance is when you have somebody that's pivotal to the business, and they're so pivotal that if they weren't able to work or they got injured along the way, the business would financially suffer. The good thing is you don't really have to validate that to the insurance company who that person is. Really, they just need to be employed and generate an income from the business, right? So what you're doing in that situation is you're saying, hey, the business is going to own an insurance policy on you, right? And if something should happen to you, then the business is going to inherit, the funds, right? Now, the business is the owner of the policy. The business is the payer of the policy. The business is the beneficiary. The key person is the insured. Why would anybody, the insured, agree to let a company typically put a policy on them? You got to give them something, right? So one of the norms that you're going to give them is a percentage of that death benefit is going to go to the family, right? So let's just say you do an analysis on an employee, a foreman, or whatnot, a pivotal worker, and you're like, man, it would take us 5 years to replace this person, and we would lose X amount of dollars in that 5-year period. Let's just say that number was $1 million. Let's take out a $1.5 million policy. $1 million of it is going to be assigned to the business to replace the financial loss of that person no longer being here. The other 500,000 is going to go to the family of that person. That's what would entice the key man individual of saying, okay, I don't mind you putting an insurance policy on me, right? That's the general concept behind it. You can use, term life insurance to fund that type of a project. Or if you want to add golden handcuffs, right, as we talked about, you can do a permanent cash value policy. And the reason they call them golden handcuffs is because you can structure an agreement with the person where if they serve, 5 years with the company, they get X amount of bonus, 10 years with the company, X amount of bonus, 15 years with the company, X amount of bonus. And what you're basing that bonus off of is what you're anticipating the cash value of those policies to be worth. So if you use a permanent policy, you can use the cash buildup as a bonus to the person, right? It's a golden handcuff because they look at it and they go, why am I going to leave? If I serve X amount of time period, I get this lump sum bonus. It's taxable because you're still going to 1099 them that bonus. So it'll still be a write-off to the business. But ultimately, that's what you create. That's how you create a golden handcuff type scenario. Does that make sense?
Yeah. So real quick, so for key man though, you don't have to show the value of the employee. I mean, they could just put it on anybody. It doesn't matter. There doesn't have to be any kind of validation of the key man.
Yeah. So once you get over $2 million, now you gotta prove the value of the company before you gotta prove the value of the man. The value of the man really is just, hey, this person's employed. Look, he's a part of our payroll, or he's a part of our 1099 subcontractors, right? But when you get over 2 million, you got to validate the valuation of the business. So if they're saying, hey, you're putting $2 million on this guy, show me that you have a business that generates well over $2 million, because we want to know what portion of this part of the business this guy is really, intricate to. Does that make sense?
Yeah, and so the person that you want to put the policy on still has to go through underwriting. I mean, they still got to be healthy and all that stuff, right?
Full underwriting, none of that stuff.
Okay.
You're not going to be able to avoid that. You still got to go through full underwriting as though it was a regular plan, right? Because remember, they're gonna put themselves on the hook for the $1 million or $2 million or $500,000, whatever it is. It doesn't matter if it's a term policy or an IUL or a whole life. It doesn't matter. It doesn't matter what the purpose is. They're still on the hook for the person's life. So they have to underwrite him.
So
Tony, how do you just? Oh, go ahead.
No, go ahead.
Tony, how do you, in this situation, how do you determine whether or not, do you work through it with the client, whether you're going to do, a par whole life, an IUL, or a term? Is that, how do you come to which product is going to best suit that client?
Honestly, I present all three. You know what I mean? I have a presentation called the 4 types of insurances that I present. It doesn't have par whole life in there, but if I was talking to a business owner, I would present term insurance as an option. I would present par whole life, and I present IUL, and I probably even would present a GUL, and then let the client determine which one it is that they're most interested in, the most cost effective. And I talk about pros and cons to each one of them, right? So when I'm talking term life insurance, I'm saying, look, the positive is this is very cost effective. This is in place for a 30-year window. The negative is it expires, doesn't build any cash. It's a good solution from an insurance side, right? You know, when I talk about the GUL, I talk about typically like a North American or American National GUL, and I go, look, there's a return of premium on here. So if the client fulfills 20 years, you can create a structure where if he fulfills 20 years with you, you know, he's going to get half of this premium and you're going to get the other half as a return. You know, if he accomplishes a 20-year window with you, or a 25-year window, because that's how the GUL is structured with North American, where on the 20th year or on the 25th year, either or of those years, the client can exercise the return of premium and get all their money back. Right. So I'll present that, you know, then I'll present the differences between IUL and permanent and whole life. Really the difference is the floor guarantees. That's the difference, right? When you structure a whole life policy, you've got that conservative. You're going to have a baseline floor guarantee somewhere between 3.5%, 4%, whatever that floor dividend is. When you're talking about the IUL, you're saying, look, no market risk, but there could be years where you don't make anything. And so, you know, I really want to see what their risk tolerance is when it comes to the permanent insurances. Once I presented all 4, I let them kind of tell me, okay, from a budgetary standpoint, what can you afford? And the budget really helps as well to determine which route to go. Does that answer your question, Trevor?
Yeah, that makes sense. And then really it just comes down to, I mean, on the illustrations, it's just showing them and educating them properly on the expectations. On the IUL, it's just a riskier play. They're not going to lose anything. But there's a potential for the upside. Reality is par whole life in a lot of cases is going to be that. Just depends on the client, right? But an older client, anybody over 35 up, sometimes a par whole life would probably be a better suited scenario.
It really, honestly, it depends on the risk tolerance. Here's what I will tell you. When you're structuring the golden handcuff agreement, if you're using whole life, what they typically do is they can look at the guaranteed column and then be like, look, if you serve 10 years with us, this is exactly the dollar amount we're going to give you because it's a guaranteed number. Whereas if you're going to do an IUL, instead of structuring a dollar amount, you do a percentage. Look, if you serve 10 years, we're going to give you 50% of whatever this is worth, 75% of whatever this is worth. At least that way, they're not tying themselves to a dollar amount in the event that the market doesn't perform. Right.
Gotcha.
But I'm very big on educating the client and then giving them choices. And everything that I present has a pro and a con. So when I talk whole life, I go, look, you've got a conservative path here. You do. You have a very strong conservative path. However, this is an either or scenario, meaning you're either going to get the cash or you're going to get the insurance. You're never going to get both. Right. And your growth is going to be very conservative. You're going to be in that 4.5% to 5% type range. If we go to the IUL side, you're going to be able to have access to both the death benefit and the cash, right? You're not choosing one or the other. You get access to both, and you're going to have a little bit more. You have an opportunity to make a little bit more of aggressive return, but you still walk away knowing that in the event of a down slope market, you're not going to lose anything on the down years. The worst thing that you'll lose is the cost of the insurance. But if we properly structure this, where we're overfunding this by the right percentages, we can protect you during those down years. And let's face it, historically, over any 10-year period, you can look at the market. There's never more than two downward slopes in any 10-year time period. So if you look at this long term, you'll make more here than you probably would your whole life plan, as long as it's structured the right way. But I give them, here's your pro, here's your con, and then they typically decide.
And then fees are going to vary because you've got, like, on an IUL, you've essentially got an annually renewable term, right? So you've got your policy fee every year, and then you've got the cost of insurance on top of that. So is that where a lot of that expense comes from in comparison with a par whole life? it's in place, your cost of insurance is going to be a little bit lower.
Yeah, I mean, the reality is like whole life is like a front load. You know, there's costs and it's front loaded, right? So you can predictably know this is what you're going to pay up front for the cost, right? IUL, it's adjustable comp, so it's annual renewable, so it goes up every year as the person gets older. So that one, the fact that it goes up means that you've really got to catch up on your cash accumulation your first 20 years. So I get into that, like that type of conversation, I get into with agents. I don't typically get into it with clients. Clients won't dig into it that deep in reference to annual renewable, level term. When you break it all out, when you look at it long term, it all almost ends up being about the same cost of insurance. It's just whether you're capturing it in the front or capturing it in the back.
Gotcha.
So say it's a business owner that wants to, whether it's key man or golden handcuffs, whatever you want to call it. Do you also base how what you're presenting on the age of the employee? So, you take a 50-year-old who's still got 15 years to work compared to a 40-year-old who's got 25 years to work. I mean, is there a different approach or
Yeah. Yeah, so that their age really helps me determine if I want to go whole life or IUL. I will say that if they're in that 50 plus spectrum, I'm going to lean them more towards whole life. It's more predictable. You got the floor guarantees than I will the IUL. If they're on the younger spectrum, I'm going to lean them probably more towards the IUL because they have that longer time horizon before they want to pull the plug of retirement, and therefore they have time to recuperate any negative market years. But yes, if I'm dealing with someone in their late 50s to 60s, I'm not going to lie, I'm not very big on soliciting either or. I'm bigger about soliciting a GUL as a solution for the client, just because of the return of premium and just because it's a guaranteed type of a structure. It's typically more cost effective as well than a whole life policy. But I definitely wouldn't bring them into an IUL world. IULs to me are 20-year-olds, 30-year-olds, 40-year-olds, 50-year-olds, if they're putting in some substantial dollars, and as long as they understand this is not something that's going to 3x their money. This is something that's going to make them 1.5 times what they put in type scenario. As long as they get that, I don't mind. But even then, I'm overfunding like crazy.
Unless it's a high net worth individual that can for the first 5 years put in some good heavy change.
Yeah, that's what I was saying.
Still be able to wait.
Yeah, that's what I was saying. If it's in their 50s and they're able to put in some substantial dollars, then yes, we're talking about. I'm not talking substantial like $300, $400, $500. I'm talking you're putting in $2,000, $3,000, $4,000 a month, or you're front loading $50,000 up front type scenario. Then I would, but again, the conversation at that point is you're not going to 3x your money. Let's get that out the window, right? If you look at anything, any kind of marketing that IUL solicit, it's always talking about 3xing, 4xing, 5xing the money. We don't have the time horizon to make that. You'll make 1.5 times at best with this type of structure. However, you've got the creditor protection, you've got you've got all these other added benefits, the ability to draw out of this money tax-free, create infinite banking for yourself type concepts. Like I sell all the other values that come along with it. You know what I mean? And I heavily hit on the fact that they can tap into this money before 59.5 because it's not a qualified vehicle. So I wrap it with that. And if it makes sense, perfect. It's probably also going to have a very low death benefit. I tell them that up front. I got to keep your costs down because you're fighting time. You're fighting the cost of insurance because of your age. So I'm going to drop this face value down and really focus more on the cash accumulation. So if your objective is death benefit protection, I wouldn't lean you this way. Let's talk about a GUL. If your objective is cash accumulation, then I will lean you this way. We're going to reduce as much of this benefit as we possibly can based on the dollar amounts you're putting in.
Okay. So, I mean, would you? So really, with either the key man or golden handcuffs, wherever you want to call it, one, it just really depends on the individual that we're wanting to maintain, and really which policy we're emphasizing the most, but we're still going to provide all 4 scenarios, correct?
Yeah. Yeah. I mean, you can't. Golden handcuffs is never going to be a term life solution. Term life will never be a golden handcuff type conversation. Remember, it's called golden for a reason. Gold represents money, right? Value.
Right.
So there's got to be some type of a bonus structure that they're going to get, and you can structure that based on a time period served. That's really what it's there for. So first you have to uncover the need, right? You got to make sure that the owner realizes there's a gap. And the way that I typically introduce it is, tell me who the key players are of your business. This guy, this guy, this guy. Okay, who are they to the company? Are they owners of the company? Are they contractors? Are they pivotal employees of the company? Like, tell me, this person. Okay, if this person wasn't here, what would happen to the business? And I have them start role playing that to me. Tell me. What I'm doing right now is I'm creating FUD. Insurance is to protect risk. So you got to make them aware of the risk, right? That's what it is, risk management. That's what insurance is all about, risk management. So it's like, let me first make you aware of the risk, and let me put you into that scenario, and let me let you live in it for a little while. That's an emotional type of a sale, because I'm simply saying, if this guy wasn't here, tell me what would happen. Tell me how that would affect you in your home, in your free time, in your finances, in the business, in the revenue. Tell me how it would affect in all those areas. In your home, you're not working double. You're working double overtime. Wife's probably not happy. Kids miss you. You're probably stressed out because you don't have your normal freedom of time to go to your church and your gym and your family time. Tell me what's happening in your business. Tell me how pivotal this guy's specialty is to the business. Oh no, the business with this, all that stuff. Once I create that FUD, then I say, listen, would it be important to you if I could find a solution to make sure if something happened to this individual, the business at least was financially protected, and with that money, you can invest into finding ways to replace the individual without the business suffering financially. And that's one question, right? Yes or no? Usually it would be a yes, right? Once I've created that FUD, it's almost like a rhetorical question. They're like, yes, it would. Okay, great. Let me ask you a question. Would it be important for you to make sure you can protect this employee from leaving to a competitor and creating a golden handcuff type situation where it's just too good for him to leave? Would that be important to you? If I can show you a way to offer him something that would create retention, right? While still giving you the tax benefits. Yes, that would be great, right? I need to know that. Because if I get a yes to one, but a no to the other, yes is term. The first one is term insurance. That'll solve. But if you want to create a golden handcuff situation where you're gonna create a scenario where that person is looking at your employment as too good to leave. So when competitors approach them and say, hey, I want to offer you X amount of money, they know they're leaving a lot of stuff on the table. They're more tempted to say, no, I don't want to leave because of that scenario, or I'm going to serve this X amount of time period. Now we're talking permanent insurance with cash buildup.
So if we're just strictly talking key man, not the executive bonus piece. You're saying term, but couldn't I also write it as a whole life, so that way that the business owner, say that individual leaves instead of dies, so he just leaves, he doesn't care about what happens. So now that business owner has a cash value already built up. He's been spending money on this guy to stay. Now he leaves. So instead of writing a term, I write a whole life, and that way at least I get some kind of cash value back.
Yeah, you could. You're right. So let me give you a scenario. I had a client that was he was in his 40s. He ran a trucking business, but his health wasn't the greatest. He really liked the concept of permanent insurance, but he didn't. It wasn't going to be a solution for him because he was so heavily rated that the cash value wouldn't grow. He has a foreman who was half his age, in his 20s, who's pivotal to the business, not because of the skill set, but because of the time freedom that he gives him. This guy's in his 40s, and he wants to be home at 2:00 every single day, spending time with his kids and his family and stuff like that. That's what mattered to him. So this 20-year-old foreman gave him that ability. 20-year-old is healthy. What I did, I said, look, I know you want to build up cash value for yourself, but you also want to protect, your boy over here. Why don't we put together a key man policy on this individual? But instead of using term insurance, let's use a permanent cash value plan, right? And now, it's $1 million policy is what it was. I go 700,000 of it goes to the business, 300,000 goes to his family. So he's getting something in exchange for it, attach. And I told him, I said, attach a $10,000 bonus if he fulfills 5 years with you or whatever. Like, let's attach something to it. But the rest of the cash value is yours. And because we're creating the initial there's insurable interest, right? Because there's insurable interest, you're leveraging that person's health to build up cash value on a tax-free basis. And when when he leaves or when you retire or whatever it is, you can sever the key man. You're still the owner of the policy on his life. And now all of a sudden it's your tax-free money you can tap into because you're the owner, you're the payer, you're just not the insured.
Right, which means you can touch the cash value once it's passes. I don't even know if there's a surrender, but I mean, there's surrender value, but I mean, once it even equals out, you really don't want to touch it prior to that.
A parent can technically do it on the child. You can do a parent can do that on the child. Own the policy, pay for the policy, be the beneficiary, and tap into the cash on the child's insurable needs, insurability.
Right. Same. So basically the same concept.
Same exact concept.
So to go back to the executive bonus, so if let's say we set that up, whether we use an IUL or a whole or par whole life, it doesn't. We'll let the owner decide that. But how stipulations? Can we put stipulations in, like, you have to stay 5 years in order to reach, access 20%. You have to stay 10 years to reach 50. To be able to put certain stipulations on that, so an individual doesn't say, okay, look, you just funded me a nice little policy. I'm gonna stay around about 3 or 4 years, and I'm gonna roll because that's my policy.
It's not his.
Can we write it?
He's only the insured. He doesn't own the policy. He has no rights to call and ask about the value of the policy. He has no rights to call and ask about, it's nothing. He's not the owner. He's just the insured. The only person that can actually call the insurance company and ask questions is the owner of the business, because he's the owner of the policy.
So for an executive bonus plan using life insurance, the owner is still the owner of that. I mean, that person can't walk away with it unless there's a written agreement.
Well, executive comp plans are different. Executives, you're talking about the owners of the companies, right? You're talking about the owner. If there's only one owner, he's not going to walk away from his own company. And if there's two owners, they cross own each other.
Yeah, I'm not talking about like that. I'm like saying, if I've got, let's say I own my own electrical company, my master electrician.
Oh, but I'm losing you. Sorry.
I lose service. Are you there?
Yep, I think you're back now.
Okay, I think Trevor lost service. All right, so basically what I'm saying is that, let's say I own an electrical company, and I want to offer an executive bonus or whatever you call it for my master electrician. I don't want him to leave. So I'm still the owner of that policy, is what you're saying. He's not the owner. So if he leaves, he can't take that policy with him.
Correct. Now, let me help you out a little bit though. The scenario you just created right now, it's still not an executive comp plan. That's still just a key man insurance plan with cash buildup. The term executive comp plan means policies on the owners. Whenever you hear executive comp plans, it's the owner's policy. If you're choosing to put it on a foreman or anything like that, it's just a key man policy. Yeah.
Okay. So that's the difference. If it's on anyone else other than the business owner, it's a key man. If it's on the business owner or even the business owner's partner, that's an executive plan.
Correct.
Got it.
Correct. And then you create the whole golden handcuff concept by putting it into a permanent insurance policy. That's what it's all about.
And you're saying when presenting this, I mean, I don't know if you said you use your four definitions of a life insurance. That's if you're doing like a presentation or something, but really when it's more just talking to a business owner and building a relationship, right?
Yeah, my first meeting is a fact finder. That's where I'm getting the facts, getting the names, dates of birth. I'm getting the analysis of how much insurance we need. I'm creating the FUD. That's all I'm doing in the first meeting. Second meeting is presentation. Now I'm going to present to you the types of insurances that exist without showing you illustration. I'm just going to conceptually share with you how these insurances work. And then whichever one you tell me you're interested in seeing, I'll have illustrations ready to show you.
But you're using just that 4-slide PowerPoint it's in the back office that illustrates the 4 levels of insurance, or do you have something?
Me personally, I don't. Don't. What I do is, if you've seen me do presentation on the dry erase board, I typically bring with me a yellow legal pad with a black Sharpie.
Just draw it out.
and I just draw it out because I'm telling a story along the way. And I find that if it's blank, they're going to follow where the writing is. If I show them the presentation, their eyes are going to be scattered about looking. I have that presentation there more for people who still don't know how to draw it and need to learn it. But I tell all my guys, if you don't yet know how to draw it, you shouldn't go to a business owner and start talking. Because business owners have the ability to invest big dollars. Don't gamble with that.
Plus, I think it shows more credibility if you can actually draw it out than actually just try to throw up a screen and try to talk through it. If you're
I'll tell you something that's helped me out a lot. If I'm talking to somebody, I'm talking across the table like this. I'm drawing it in reverse. I'm drawing it in a way where they can see it, but it's reversed to me. And one of the, it's that simple little extra that gives you so much credibility where people will be like, man, you really know your stuff, bro. You're doing this backwards. Yeah, you're not my first line.
That's powerful. So what I'm taking away from this particular part is to learn them slides to the point where I can do it backwards. Hey, here you go.
You're going to be going out to talk to high net worth clients, business owners that are willing to put $2,000, $3,000 a month into these strategies. You got to be on your A point. You got to be on your A game. Somebody that's going to drop $3,000 a month into anything needs to make sure they're doing it with somebody that they don't want to feel like the first guinea pig to the project. Does that make sense? I don't know if I lost you. I think it froze. Hello. Hello. I think signal just went out, bud. Oh, just lost him. Comes back on. Yeah. There we go. You back?
Can you hear me?
Yeah, I lost you there for a bit. I don't know if you heard what I was saying, or did I freeze up as well?
I think we both lost each other.
What I was saying is you want to make sure when you're going to go out and talk to somebody that's about to drop $2,000-3,000 a month, you want to be such an expert that they don't feel like they're the guinea pig. I mean, they're talking serious dollars, especially business owners. They value their business so much. They want to make sure they're working with experts. So all of those things have dramatically helped me, to be honest with you, all of those.
So that brings up a question, Tony. What is there? So when doing these key mans, is there a limit? I mean, can a guy put 50,000 a month? I mean, I don't know.
The first thing is the insurable. So the amount of money somebody can put in is based on the size of the insurance policy.
Correct.
So pretend the insurance policy is like a bucket, right? It's an empty bucket, and you're going to fill it up with water, aka cash. The bigger the bucket, the more water you can put in, right? And so the first thing you have to be able to get that the client, to get the insurance company to approve, is the face value.
Right.
Face value, because that's what the insurance company cares about. They don't care about how much cash you're putting in. They care about how much death benefit they're on the hook for. The insurance company will do just as much underwriting on a term insurance policy as they would an IUL policy, because the IUL side of it, the cash accumulation is for the client. They still got to write a check if it's a term policy, the same way they would write a check if it's an IUL.
Okay. All right. I think I have enough for this piece, but I do want to understand. So for the executive piece, would we be pitching more of like a Kaizen / premium finance type of deal for like the owner themselves, or are we still pitching something very similar?
It depends. Premium financing is advantageous for the person that wants to leverage the bank's money, right? And has, a 15-20 year minimum type time horizon. So what exactly is premium financing, right? For number one, there's some rules to it. The first rule is it's minimum $25,000 a year for a period of 5 years. That's the minimum. And the first year, you got to drop the whole thing up front. You can't make monthly payments. You got to pay the whole thing up front. That's the first rule. Second rule is that you got to be able to verify that the client's making over a 6-figure income, right? That's the second.
Yep.
Now, what exactly is premium financing, right? For the first 5 years, go ahead.
You also have to have collateral.
No. No, that's the part that's advantageous about premium financing. The IUL becomes the collateral. You don't actually have to have tangible collateral. The IUL becomes the collateral because the way they structure it is to where they know confidently that the cash surrender from year one will always be enough to cover the loan amount in the event that the client defaults.
And the loan amount is still based off the amount of death benefit.
The loan amount is based on the amount that the client's putting in. So if the client puts in 25 the first year, right, the bank is going to put 25. They match you, right? And they match you for 5 years. You put 25, they put 25. You put 25, they put 25. For 5 years, they match. Then what happens is on the 6th year, you as the client, you don't got to put any more money in. And now the bank puts in your shares and their shares. So they put in 50 now for another 5 years. So what ends up happening, you put in a quarter of the money, they put in 3/4 of the money. That's what's essentially happening. That loan has to be paid back on the 15th year at an interest rate of what LIBOR, whatever LIBOR interest rate is, which is around 2.25, right? So why is it advantageous for the consumer? The consumer looks at it and says, man, if I'm earning, 6.5% on the index, and I'm earning it not just on my money, but on theirs as well, and I get to keep the majority of that return, all I got to do is pay back the loan amount and 2%, but I get to keep the net interest difference. I could really maximize this $125,000 that I'm investing. That's the way they got to look at it. I'm putting up 125. What am I going to get in return?
And so the minimum is 25,000, but I mean, if let's say I run across a guy who's got $1 million a year he wants to put into it, it's still whatever the bank is willing to loan. But at some point, is there a credit check? I mean, depending on the level?
Nope.
So I could
because it's collateralized by the IUL. The cash they structure the IUL so that the cash surrender value from year one will always cover the loan balance. So in the event that the client defaults, they're just going to take it from the cash surrender value, and the bank is always made whole no matter what. So it's going to have a high level of overfunding is really what we're getting at.
So there's a minimum, but there's really no maximum on what you can put in for the 5 years.
That's based on how much insurance we can get the guy qualified for.
Well, see, that's what I was asking. It's still based off of how much insurance he can be qualified for.
Yeah, that's always going to be there. The insurance company, again, you got two people looking at this. You got the bank saying, you got the funding company saying, hey, let me look at this from a finance standpoint, right? Do you make 6 figures? Can you afford $25,000 a year? Show me. The insurance company still looks at you like a client and says, hey, can I insure you for this amount based on your health? And if we're taking out a $2 million policy, why is it so much? The reality is premium financing, when someone's looking to do those types of dollar amounts, insurable interest is easy because they're already high net worth people. You're not going to find middle Americans putting in 25 grand a year into insurance. You're just not. Anybody who wants to put 50 grand or $1 million into it, they have assets.
Correct. And so I guess basically Allianz is our main go-to when it comes to this type of policy.
Allianz and NLG are the 2 carriers that we have that are approved to work with Kaizen.
Okay. And are they just using like basic interest rate assumptions, or is there, are they just basing it off of the index, whatever index they choose? Or
I sent an illustration over to Trevor. I don't know if he sent it to you, but Kaizen will actually send you the illustration of the IUL along with the premium financing numbers already embedded into it, so you can see it. It's a pretty cool structure. It's actually a really cool structure. They base it, I believe, off of a 6% interest rate, and then they base the loan payback at, I believe, a 2%, because the loan payback is based on LIBOR interest rates, which like I said, it's always between 2.25.
And that loan repayment is always done on the 15th year.
You could do it sooner if you want and save yourself on the interest, but the 15th year is the call date.
And so you said it was a minimum of 5. Could they do like a 10-year,
Yeah.
So you can set it up, but just the minimum is at least 5 year and $25,000.
Correct. They can do longer if
And-
they want to. They could pay back the loan with other funds if they want to, and not even surrender the money from the policy if they didn't want to. It's pretty attractive.
So what happens on a year that let's say the stock market, so zero's your hero. So let's say a year that there's no gain on the index. Do they have to add a little bit more money that year in order to be able to stay ahead of the policy?
No, because
No.
that's why I said premium financing cases are heavily overfunded from the beginning, because they got to make sure that their principal is still protected. So that cash surrender value needs to tap into in year one. So there's always going to be a huge amount of overfunding.
Okay. And why do we use IUL for this type instead of a type of like a par life or something? Why is a
I'll be honest
IUL?
with you, I don't know the answer to that. I'd talk to Kaizen and find out why. Allianz only sells IULs. NLG sells whole life, so maybe they can do something with whole life. Maybe they can do something with whole life through the NLG platform, but I don't know the exact answer to that.
Because I'm just curious, because with the IUL there is a little bit more of a, it's really based on risk tolerance, what you're willing to tolerate. But for those guys who say want to pump in a bunch, but they don't really want that much risk, they want the more guaranteed. Okay, I know I'm gonna get 2 to 3% because I got to pay a 2%. Payback.
Yeah, I don't know. If I had to hazard a guess why, it's whole life is so much more conservative that you risk, pretty much giving back the bank what you made, right? If the bank is charging you LIBOR 2.25 and the dividend is only paid at that 2.25, you know what I mean? Then you risk, giving back essentially what you made. So maybe the illustration doesn't look as attractive. I don't know the answer to that. That would be a Kaizen question. That'd be good to talk to them and ask them.
And I guess if you're trying to be that conservative, then you just sink it into your own personal whole life policy yourself, I guess. I don't know.
Correct.
I'm just curious. I didn't know why it was just strictly, for an IUL product.
Yeah. I mean, here's an analogy I'll give you that'll make sense to you, right? People go to the banks to open up money market accounts, even though they could go to a broker house and open up a money market account.
Correct.
Why? It's because it's just notoriously known for being a conservative investment. So let's go to a bank. Premium financing is not that. So although I'm sure you could, it's mostly probably done with IULs for that very reason. It's for that person that's willing to take the gamble essentially on a low interest rate, a couple low interest rate years.
And so for talking with people about premium finance, it's basically the same thing what we were just talking about earlier. Don't try to go in with all these bunch of charts and stuff. Really go in with some paper and
what I just did with you right now
and get interest.
What I just did with you right now is exactly what I would do to a client. I mean, literally what I just did with you right now. I explained to him how an IUL works, the fundamentals of an IUL. And then I go, listen, what if I had a bank that's willing to put up 3/4 of the money, you put up 1/4. But that quarter has to be a minimum of $25,000 a year for 5 years. So you put up 125, they put up 375,000 minimum. And now all of your money is earning 6 to 8%. And then on the 15th year, the bank wants their money back plus 2% interest. Would that be of interest? And you get to keep the net for it. Would that be of interest to you? Well, yeah, that would be amazing. I mean, can you afford $25,000 a year for a period of 5 years minimum? Because if you default and you can't make your payments, the loan stops, they take back all their money, and what is, and what isn't. That's the conversation I have with them. Once they tell me yes, then I go, okay, well, what kind of numbers are we talking? This 25-year minimum? Do you want to put 50 in? I mean, what can you do for a 5-year period, no matter what? And they give me their number. I go, okay, give me 3 days. Let me put together some illustrations. I'll get back to you.
So can this concept also be used for a key man, or is it just?
I don't see why not.
Sold?
I don't see why not.
That's what I was thinking.
I don't see why not. I don't. You'd really be dealing with a very big company if they were doing it on a key man plan, because you're talking some substantial dollars going in. I would probably see that strategy more in executive comp plans than anything. If the business owners wanted to do something for themselves.
Okay.
Most of the business, most of the executive comp plans I've always done have been attached to a cross purchase agreement. So it's typically 2 business owners that do it for each other.
They put each other on an executive plan.
Yeah.
Okay, and what's it's just I mean, what do you call that? It's still just executive bonus plan, but on two separate
Yeah,
individuals that own the company.
it's an executive cross purchase plan.
Okay.
Yeah.
Okay, cool. I think I got enough to at least start talking. I'm gonna start studying your slides so I can write that,
Sure.
draw it out myself. But I know we got a little bit more. I know we set up an hour, so I'm gonna try to use a little bit more of it if you don't
Go
mind.
for it. Go for it.
I got a separate question in regards to annuity. So I'm talking with an individual. He's got about 75,000 set away between in a Roth and in a brokerage account.
Okay.
But he's married to a lady who's in the Philippines. Okay, it's a weird arrangement.
Okay.
So he's telling me he's got 400,000 in a bank there in the Philippines. The bank account's in her name. Now she does have a taxpayer number for the United States because they are married. He's wondering if that's possible to roll that into an annuity, but do it so it doesn't make it to where I told him I didn't know how it could be done because I don't know enough about annuities, but it didn't sound like something that could be done. But he wants to be able to get that into an annuity without triggering a tax event. But I don't know I don't know that you would have to prove that it's taxable income.
It's going to automatically trigger a tax event no matter what.
It is. Okay.
Yeah. After the U.S. Patriot Act in 2002 happened because of 9/11, right? 9/11 was funded by traffic dollars that came into the United States, and so sourcing now is going to be huge. The moment money is going to come in to the United States, it's got to be validated. So we could not take the money directly from the bank over there. That money has to transfer first to a U.S. bank before we can take it. That's how insurance companies shielded themselves. They just don't accept money from non-U.S. bank accounts, period.
So if he wants to do this, he would have to get that money. That money would have to be wired to his bank account here, if he wanted to do that.
Which is going to
about a year from retirement.
Yeah, which is going to immediately trigger a taxable event. There's not an insurance company you're going to ever find that'll take dollars from a non-U.S. bank.
Yeah, and that's what I told him. I told him, I said, this is probably highly unlikely. I mean, this is almost like hiding money in offshore accounts. And this is a conversation I had with him and someone else. So both of them are 1 year away from retirement, and they have 401s. Once they're done with their retirement and they're not contributing any more into it through their workers fund, can that 401 be rolled into an annuity? They won't have to worry about the 59.5 rule, but they'll still have to pay their tax on it, correct?
Not when they roll the money in. When they take money out of the annuity, they will.
Okay. So when they take money out of the annuity, the whatever they take out will be taxed.
As earned.
So what's the benefit? What's the benefit of rolling a 401 into an annuity? Is there, or what is the better avenue?
There's a big benefit. There's a massive benefit. There's a massive benefit. I did about $1.5 million last year just in 401s. 401ks have internal fees, 2 to 4% every single year.
Yep.
Annuities don't. 401ks don't give you lifetime income options. Annuities do. 401ks is going to be attached to an individual. An annuity could be attached to two. You can make an IRA. You can make an annuity where the beneficiary is still two people. So there's a lot of benefits to it. 401ks are typically invested in the market. Now it's about risk tolerance, right? I can move you into an index fund and get you into that strategy instead. The top two most attractive is lifetime income options, right? 401 doesn't give you that. It's not a pension. It's a lump sum withdrawal. Annuity gives you a lifetime income option and zero fees, while you're accumulating, where 401k doesn't give you that.
Does the annuity offer any type of living benefits or death benefit or anything like that?
Some do. Yeah. Some give you like a 20% bump up on death benefits. You put $100,000 in. If you die, you get $120,000. Depending on the state, there's a thing called an income doubler, where if you take out the lifetime income and you become disabled, you get a long-term care need. That income doubles because of a long-term care need. So I use sometimes annuities as a long-term care solution for someone who's medically unable to qualify.
And would you roll them into like a fixed index, or would it be like a single premium? I mean, how would that be? How would it be structured?
90% of what I do is single premium index.
Just single premium index.
Yeah.
All right. And it's not I mean, I've never done one. Obviously, I would utilize, obviously, TKO to do that, but are they that difficult to do? I mean, after 3 or 4 of them, would I be able to do them on my own after that? I mean, typically, how long does that process go?
So the thing about annuities that's tricky is this: the application has to be in perfect order when you submit it. Otherwise, you're going to be going back and forth to the client for initials and adjustments. You know how like life insurance, you submit it. If you make a mistake, you can tell the underwriter, hey, this was wrong. And they'll just add an amendment. And at the end, client signs it. So it's easy. Annuities aren't like that. With an annuity, while it's in underwriting, you got to print out that page, edit it, adjust it. The client has to initial where the mistake was done. So if you go back enough times, you lose credibility with the client. Number one. Really, the tricky part about an annuity is where the money's coming from, right? So if the money's in a checking account, it's annuity application is super easy. But if the money's coming from a 401k or the money's coming from an annuity, you've got added paperwork that you got to do. And so you've got replacement paperwork that needs to get done. You've got annuity suitability paperwork that you need to get done. That can get sticky if you don't know how to do it. So I would encourage you, it's really your ability to learn, right? I've never seen anybody be able to do annuities by themselves until they've done at least 3 or 4 with somebody.
Okay.
Once you've done 3 or 4, then you're kind of like, okay, I kind of get it. I understand now.
So am I utilizing somebody from TKO or UMS to help with?
You would utilize somebody from TKO.
Okay, good.
UMS is advantageous for like the case designing, right? Let's put together the case. Let's put this, but the action, and they're willing to go to the field with you. But at the end of the day, these are admin people. These aren't salespeople. You want to take somebody that knows how to go to the field and do big rollovers.
And would I just reach out to you and say, hey, Tony, I think I got an annuity case, and just reach out to you personally?
Yep.
Okay.
Simple as that.
All right. Okay, cool. I think that's it for now, man. That's a lot of information.
All right, brother. I'm here, man. Like I said, it's easy to get me on schedule. Sometimes I might not be available for 3 or 4 days, but you get me on schedule, and I'm here to help answer whatever questions you have.
Well, actually, I got one more question. So I have written IULs with F&G. So compared to Allianz, I mean, why is Allianz always ranked, better than F&G? Where F&G actually illustrates, they have a pretty decent illustration with that Barclays. But I can't wait to get a hold of Allianz and start playing around with some illustrations. But between it, Pacific Life, I guess, is the other one of the other top IULs. I mean, what's just so special about them?
So you're right. F&G is a very good IUL. I'm excited to bring them into the platform. Actually, Allianz has 3 things right now that make their IULs exceptional to the competitors. One is got an auto rate lock feature, so you can tell the IUL, listen, if it hits 9% any day in this 365-day period, I want you to lock me in at that rate and make that year I'm going to make that interest rate no matter what, right? Most indexes is whatever is from point to point, right? So if the point starts here and ends here, and the index goes up and down and up and down, it doesn't matter where it was in the middle. It's a matter of where was it from this point to this point. So creating an auto rate lock lets you cap in on one of those crazy days where the market shoots up. That's one. The second is the fact that it's a participating loan, which is very attractive. Participation basically means when you're borrowing against it, you're borrowing from Allianz, not your own cash value. 100% of your cash value is still invested in the index. You're borrowing from Allianz. That's number 2. And number 3, they have a 5% fixed interest rate loan, where most IULs are variable rates, and they range anywhere from 10 to 12%. So at the end of the day, you can tap into a lot more money because of those features in the Allianz platform than any other company I've seen.
And is Allianz your go-to IUL company? For
cash accumulation? 100%. 100%.
Okay, cool.
If I talk to someone that's more living benefit focused, I'm probably going to go to American National or NLG. Yeah.
Okay.
All
right, cool. Well, yeah, man. So, all right, look, I appreciate it. Like I told Trevor, I'm excited to be a part of this group. I look forward to some good things, man. So I appreciate everything.
Awesome, brother. You have a good one.
Have a good day.
Bye.